The recent slamming of gold and silver and its purported implications for the next big move have been the subject of much discussion. We're going to disentangle fact from fiction in this video, and you'll leave feeling much more at ease, more clearer, and much more assured about what you're truly looking at. It is February 17th, Tuesday, New York time. I always enjoy seeing how far these videos travel, so before we continue, please leave a comment letting me know what day and time you're watching. Just so the algorithm knows you want more content like this, please subscribe and leave a comment on our future Ledger Anna if you appreciate logical analyses like this. You've undoubtedly witnessed some variation of the same heated opinions spreading like wildfire if you've been anywhere near the metals discussion today. Typically, it consists of a screenshot, a chart that has been cropped, and a bold caption. This is how it works. By the mid-single digits, silver is down. Gold is also declining. The dollar has somewhat increased. The decline is a fake since China is offline for the vacation. We are on the verge of launching or collapsing because the market is rigged. And it feels clean after reading that. It's gratifying. It seems to provide an explanation for everything. Here's the problem, though. The majority of viral marketing strategies are trickery. The props are authentic. The illusion is the conclusion. Thus, let's proceed as usual. First, let's examine the props. We'll then search for the secret string. First, it's true that silver suffered today, nor was it a mild red day. We're talking about emotion that makes it feel like your drink slid off the edge of the table after someone kicked it. At one point, spot was down by the mid-single digits. At the lows, futures appeared even more repulsive. Gold was also down. You could sense the change in tone in real time, though not as sharply. The kind of change in tone that causes your group chat to become silent for a moment. And you're not insane if you think that's extreme. This is the first cliffhanger, though. A significant relocation might actually happen. The suffering may be genuine, and the explanations given for why it occurred may still be inaccurate. What are they indicating then? They're indicating a sharp increase in the value of the dollar. The reasoning is straightforward. Metals down, dollars up. To be fair, the association does appear frequently, particularly on days when traders are paying close attention to macro news stories. The main topic of discussion today is the development of indirect negotiations between the US and Iran, with Oman serving as a mediator. In addition to risk moving and the dollar getting a bid, the market is also hearing progress. This is when things become interesting, but that portion is believable. The dollar seldom tells the whole story, even when it does. A situation is explained by it. Because metals can drop significantly on the same day that the dollar is somewhat higher. Mechanics, liquidity, leverage, positioning, and the way contemporary markets respond when multiple people attempt to enter the same doorway simultaneously are typically where the differences lie. Before we delve farther, I want to draw a crucial distinction that, on days like today, hardly anyone notices. People typically combine at least 3 separate arenas when they say, silver is down. The futures market, where the majority of short-term price discovery takes place, the spot quote you see on a phone app, and the actual retail market, where premiums are free to fluctuate in any way. Though they are not having the same conversation, those 3 stadiums do communicate with one another. Due to traders' use of leverage and stops, futures are susceptible to gapping and whipping. Spot is a combination of various places, therefore it may bounce or lag. And tangible can feel sticky because dealers make changes to delivery schedules, inventory, and premiums that aren't visible on a chart. Therefore, if you're looking at a red candle and believing that demand has vanished, stop. It could simply indicate that futures traders were compelled to dump their positions into a thin tape. And with that, we return to the dollar move. One headline wasn't the only reason the dollar bounced. The fact that markets are always repricing the same 2 questions is another reason it bounced. How strict is the policy? For what duration does it remain there? The bond market has been attentive to every indication of inflation, persistence, and growth resilience, and short-term rates are currently still hovering around the mid-3 mark. The currency frequently feels strengthened when interest rates are sticky. Additionally, metals can seem weighty when the dollar is supported, particularly if traders are already tilting in the wrong direction. This is the point at which silver behaves differently from gold. First, gold is viewed as a monetary anchor, and then as an industrial input. Silver has a larger industrial personality in addition to its monetary component. Therefore, even though the long-term thesis hasn't altered, silver can trade a bit more like an industrial metal and a little less like a pure haven on a day when the market is de-risking. That's why gold will occasionally hold up, okay? Silver is attacked as though it owes someone money. Furthermore, by itself, that is not bearish. Simply put, silver is silver, is. Let's now discuss the paper games claim, as this is where people tend to become defensive or perplexed. Futures are, in fact, paper contracts. In the short term, yes, you can use paper to change the price. Here's the truth, though. The short-term struggle takes place in the paper market. Even for those who are physically inclined, you hedge there if you're a producer. You hedge there if you're a refiner. You hedge there if you're an industrial user. It is where you speculate if you are a fund. Therefore, the mere fact that a paper exists does not indicate manipulation. It demonstrates how claims, hedges, and netting constitute the foundation of contemporary markets. Is it paper? Isn't the question. What can we now learn about placement from paper behavior? Additionally, the conduct of the publication today is shouting one thing. There were too many people standing in a straight line. The blush felt so strong because of this. Let me now reveal the next suspenseful moment. The following headline is not the most crucial item to keep an eye on if this is indeed a positional flush. Whether the selling pressure wears off is the question, because the market can change quickly after forced sellers are finished. Sometimes it happens so quickly that those who are panicking think they missed it because they blinked. Emotion is typically the last item to be updated, which is why the emotional swing is so important. People may reverse the price before they do. I'll give you an example. Consider a packed theater. Everything is quiet. The show is being watched. Then there's a shout of fire. It doesn't even need to be accurate. The response is what counts. Suddenly, the exit itself becomes the issue as many rush toward the same exits. Leverage affects a market in this way. It creates a rush out of regular price fluctuation. And as silver is one of the most volatile and frequently traded commodities, it is well known for this. It trends hard when it's trending. It may seem to be attempting to make a point when it corrects. Add in China's absence during the spring holiday window, the second prop that people keep bringing up. That isn't something they made up. Participation is definitely affected by the timetable modifications made by a number of significant Chinese exchanges during this time. The market may appear narrower when a large group of arbitrage desks, hedgers, and buyers are largely absent. Furthermore, it doesn't take much to move the market around when it feels thinner. However, being thinner does not always imply manipulation. Thinner implies that the price is moved farther by the same shove. Consider it similar to shifting a couch. It's steady if 8 people are pushing. Every slight prod becomes sloppy when 2 individuals are pushing. The couch is still moving, but it does so erratically. This explains why you occasionally witness these swift, unsightly downdrafts that resemble trapdoors. Indeed, we have lately witnessed that type of activity, where the price simply plummeted during a little time frame before rising again. That is often referred to as a flash crash. It's okay, but the label isn't important. The important thing is the conditions. The market is simpler to whip when there is less liquidity, spreads are wider, and stop orders are grouped in conspicuous locations. The structure is brittle at that particular moment, not because someone is wielding a magic wand. Okay, so are you saying nothing shady ever happens? I can already hear someone typing, but I'm arguing that most violent movements don't require a conspiracy to explain them. By itself, leverage and thin liquidity can accomplish the task. Forced sales can be effective. Limits on risk can be effective. Algorithmic triggers are capable of doing this. Indeed, there are instances when major players will exploit pre-existing situations. That is not the same as saying that the entire thing is phony. It's not the red candles, so let's move on to the bit that really counts today. It's the whiplash of sentiment. The talk was ecstatic a few weeks ago. People were acting as though getting the next leg up was instantaneous and guaranteed. The comment sections became competitions for price targets. Pullback was a word that no one wanted to hear, yet everyone felt like a genius. And you should use caution if you notice that. The market tends to penalize certainty, not because the long-term story is dead. Today, however, the situation is reversed. All of a sudden, fear fills the same room. Many are wondering if the run was an isolated incident. People claim that it is over. The chart is being used as a negotiating tool by people. This is the point at which I will contest a significant inference that is being discussed. The market is inherently dysfunctional if that fear persists. It doesn't. Fear is not evidence. Fear is a reaction. Fear can be a motivator. Fear can serve as a warning. It's your responsibility to identify it without allowing your feelings get in the way. Let's construct a framework then. Today's panic is predicated on the idea that a significant down day must indicate the end of the uptrend. However, a single candle does not define a trend. Structure defines a trend. In the daily view, zoom out. As you can still see, silver is still higher than it was for the majority of the previous year. As you can see, the upward movement that came before this decline was forceful and nearly vertical. Additionally, the market does not courteously move sideways following a vertical run. It breaks. It goes too far. Prior to doing the rational thing, it does the emotional thing. Because of this, even while the larger structure is still standing, it may seem as though the sky is dropping. And without getting bogged down in the details, this is where I want to be particular. On the daily chart, many dedicated trend watchers employ a long-term moving average as a sort of line in the sand. It's because it enforces discipline, not because it's miraculous. Even if there are unpleasant pullbacks, the main trend typically remains upward while the price is above that long-term average. The game frequently shifts when the price remains below it for an extended period of time. Silver is still not acting like a market that has totally lost its footing at this moment, despite today's knock. It's acting like a market that overheated and is now attempting to cool down without completely destroying the building. The momentum gauges also provide a similar picture. Momentum was stretched throughout the run. It became too hot. You sensed it. Every green day felt like a celebration, and every dip was bought right away. Currently, those same indications are becoming less active. They are moving in the direction of oversold territory in some time frames. That tells you something significant, but it doesn't promise a rebound tomorrow. Excess is being removed by the market. I keep stating that corrections can be useful because of this. The air is cleared by them. The tourists are ejected. The next rally, if it occurs, will be based on stronger hands because they punish those who abuse their power. Now, I also want to talk about a common argument that I've seen. Here's my opinion on this chop. Some people say, that's a bearish flag. It's going to break down. Others react, no, that's a bull pause. It's going to break up. Context is more significant than labels. A breakdown would make sense if the price was grinding upward each week, while the larger trend was downward. However, you are more likely to see consolidation than collapse if the price is now making a messy emotional pullback following a vertical surge and the larger trend was upward. Indeed, it was an ugly consolidation, but it was nonetheless a consolidation. Could silver fall any lower from here? Of course. Both directions of overshooting are common in volatile markets. I wouldn't be surprised to see price probe lower zones that, while they can sound frightening in a comment section, are actually quite typical during the course of a major trend. A deeper wick into the 50s, if the market truly wants to shake everyone out, or perhaps around the low 60s, around the long-term average. In that area, everything is feasible without necessarily negating the larger picture. A rapid tag of a lesser level is not what would draw my attention negatively. It would be a persistent loss of organization. For months rather than days, lower highs and lower lows have been accumulating, with momentum ebbing on each rebound and the macro environment as a whole moving toward true monetary tightening. The standard is higher than one unpleasant Tuesday. Since we're discussing context, let's take a moment to discuss ratios, which keep you sane. The gold to silver link was strained when silver ran. It entered areas that don't usually endure permanently. It can feel like silver is being destroyed when that relationship resurfaces, when the ratio mean reverting is all that is involved in the change. And there's another perspective that I think is helpful. The magnitude of the money pool sloshing around in the system is comparable to the price of silver. Markets frequently respond when that ratio is pushed in one direction. The price overtook the rate of digestion, not because the core narrative came to an end. Therefore, once more, this is not about announcing a win or a loss. It's important to understand that markets are dynamic. They go through phases of expansion and contraction. All right, let's now construct another bridge that many individuals fail to link: vitality. Because oil was soft today, even when metals were being struck. Additionally, because the market perceives less risk and greater supply security, the same progress talk that helped the dollar can also have an impact on oil prices. Here's the twist, though. Energy can shift quickly in the event that the risk reverses. Furthermore, one of the quickest ways geopolitics may appear in inflation data is through energy. When the price of oil increases, the demand for it does not immediately decline. People continue to commute, freight continues to move, power is still produced. Demand changes, but it does so slowly. Thus, a disruption in a vital lane might cause energy prices to rise rapidly, tighten financial conditions, and then influence central bank forecasts, which in turn can influence metal prices. The entire chain has the potential to make headlines. I often tell people that it's a web rather than a single plot because of this. Additionally, you will miss the spider if you are only looking at one strand. This brings us to the second cliffhanger. The most sensitive section of the complex can begin informing you the next chapter early, even if the metal chops for a while. It's a little thing. The metal is typically overstated by miners. On green days, they typically run harder, while on red days, they tend to plummet harder. Operating leverage is that. Equity risk is that. And it goes like that. Miners were hammered today. They then frequently recovered from the lows. That is significant since it indicates that not everyone was sold out. The weakest component of the complex would frequently be pinned to the ground if it were. Rather, bounce behavior was observed. It was a reaction, not a complete recovery. This is the portion that most people overlook. To surprise to the upside, miners don't need the metal to blast higher every week. The metal must continue to rise above the level that analysts factored into their calculations months ago. Expectations for earnings are sticky. Unlike pricing, they don't update every minute. Therefore, the market frequently takes time to re-prick the cash flows when the metal reprices swiftly. You get opportunity in that interval. Additionally, volatility is a cost of admission. Now, a major diversified miner who posted impressive profits and leaned more heavily into copper while also making a noteworthy move related to silver exposure was involved in one of the biggest mining stories that recently made the news. I'm bringing that up because it shows a pattern, not because you should pursue a ticker. This is the pattern. Miners can provide results that appear greater than anticipated when underlying commodities remain high even after cooling off, just because the expectations were too low. You don't need a moonshot for that. It takes perseverance. Additionally, people suffer with tenacity during drawdowns. I would really appreciate it if you could respond to this question in the comments section. Are you more inclined to sell or learn when you see a bright red day like today? Because your response indicates if you are exchanging your feelings or developing your technique. We have now discussed sentiment, liquidity, and headlines. Let's include an additional component that has been highlighted in previous market reports. The overall liquidity situation for all assets. This is what many people overlook. Metals may sell off during a wide risk-off wave, even if their long-term outlook remains positive. Portfolios are compelled to raise money, not because the story changed. Leverage players receive margin calls if volatility increases, credit spreads widen, or stocks decline. They sell what they can sell, not what they want to sell, and futures for precious metals are quite liquid. They are therefore an obvious source of income during a stressful time. As a result, you may occasionally see gold and silver falling next to items that you would typically consider unconnected. There is no conflict there. It is an instance of liquidity. Here is an alternative, skeptic interpretation of the "it's all paper" narrative. What if the primary goal of the motion is to temporarily relax crowded positioning? Silver attracted a surge of quick cash when it recently hit the low 100s. The activity of your possibilities heated up. You had a steady stream of momentum traders. Additionally, a lot of individuals treated a volatile market as though it moved slowly. The market then serves as a reminder of what it is. It removes leverage. And that shakeout may give the impression that we were harmed. In actuality, though, it's the market acting as it always does when too many people have the same viewpoint. Does that imply that there is no cause for optimism now? Absolutely not. It implies that optimism must be based on the kinds of factors that take time to fade. Let's talk about drivers now. Silver is more than just money. This metal is used in industry. It appears in a wide range of contemporary production processes, including electronics, solar, electrification, and medical applications. Furthermore, the industrial side of the narrative hasn't gotten any weaker if you follow the broad patterns. It has become stronger in many respects. Upgrades to the grid take several years to complete. Data centers continue to grow. Even if the politics surrounding energy transition spending shift, it remains a reality. Indeed, copper plays a significant role in that story as well. You keep hearing about miners turning to copper exposure because of this. Conductive metals are in high demand worldwide and are not a temporary fad. Therefore, the structural demand story remains intact even if silver chops. Add a coating of gold now. The demand story for gold has been bolstered by a topic that isn't discussed enough in regular trading discussions: reserve diversification and purchases by the official sector. The long-term demand for gold has been a consistent theme in recent years, even during periods of low activity among Western investors. This is significant because it alters the psychology of the floor. Now, that doesn't mean that prices will go up every week. I'm stating that it's the reason why violent corrections can still preserve the story. All right, since the new context is important here, let's now discuss the macro layer. According to recent economic data and policy commentary, the Fed is still attempting to balance an economy that has proven more resilient than many anticipated with inflation that is refusing to behave completely. The market is continuously attempting to predict what will happen next, and the current policy range is still in the mid-threes. The dollar may strengthen if the central bank sounds patient. Metals may be whipped around when the dollar hardens. However, the dollar's one-day bounce doesn't solve the underlying problem: the amount and recipients of government borrowing over the ensuing 10 years. Long-term public projections show that the trajectory is not subtle. There is still a lot of borrowing, high interest rates, and ongoing strain on the financial system. That doesn't mean tomorrow will be a collapse. It indicates that, over time, the system tends to be more accommodating, particularly when stress manifests. I'm not being dramatic when I say that. I say this because hard assets are typically important in this setting. Since I want this to be truthful, here is the counterpoint strategy. What if the dollar's decline isn't what propels the following stage? What if real assets continue to perform well, even if the dollar remains comparatively stable? That is possible. Due to industrial demand, reserve behavior, supply constraints, and capital spending cycles, we have witnessed times when the dollar has held up and metal prices have continued to rise. Therefore, avoid adopting a one-story perspective where everything must end. Now, since geopolitics is unavoidable in today's world, let's discuss it. There is an odd push and pull in the market as a result of simultaneously observing headlines about military posture and diplomacy. While a headline about risk near a vital shipping lane can have the opposite effect, a sentence about progress can boost the dollar and hit metals. One of those pressure points is the Strait of Hormuz. A significant portion of the world's oil shipments pass through that corridor. Energy traders therefore take notice right away when there is a story about drills, temporary closures, or escalation risk. Here's the unsettling reality. Markets have the ability to discount risk until they are unable to do so. To be clear, I'm not supporting conflict, but you will hear people say, it's priced in, and then one day it isn't. No one ought to. However, you don't get to pick the headlines as an investor. The only thing you can choose is how prepared you are. It makes sense to think in scenarios because of this. In the first scenario, discussions diffuse tensions, the dollar maintains its support, risk appetite increases, and metals continue to cool. In the second scenario, negotiations stall, risk increases, energy markets tighten, and demand for safe havens quickly recovers. In the third scenario, nothing noteworthy occurs, but the background of debt and liquidity continues to grind on, and hard assets continue to perform as they always have. Take note of what I did there. I didn't act as though I knew which one would occur. Pretending to be certain is the true error, which is why I laid out the menu. What comes next? In particular, there are a few short-term triggers that have the potential to influence sentiment. The first is the minutes of tomorrow's central bank meeting. The trailer is the statement. The director's commentary can be found in the minutes. What they want you to hear is stated in the statement. What they were debating behind closed doors is frequently revealed in the minutes. In the short term, metals may continue to be under pressure if the minutes appear more cautious about easing. There might be a dramatic reversal if the minutes were more flexible about changing the policy later. In any case, if volatility appears around that release, don't be shocked. The reopening of Shanghai and other Asian trading hubs following the holiday window is another motivator. Liquidity shifts when participation returns. Additionally, price behavior may alter in response to changes in liquidity. Next on the U.S. Futures Exchange calendar is the March delivery window. That is important because it focuses attention, not because it ensures fireworks. It tends to produce narrative storms and focuses on positioning. The key is right here. Because attention alters behavior, it has the power to influence markets. I want to take something useful and relatable home with me now. It's normal to feel a jolt of nausea when you wake up and look at your screen. Red is interpreted as danger by your brain. However, investing is not the same as wilderness survival. It involves making decisions in the face of uncertainty. So you use a framework to override impulse. What changed, you ask? Not what fell, But what did change? Did industrial demand suddenly disappear? No. Has grid build-out ceased? No. Has the debt trajectory changed course? No. Price and mood. What changed? Additionally, mood and price fluctuate constantly. Does that imply that you buy every dip without question? No. It indicates that you align your behavior with your risk tolerance and time horizon. If you are a short-term trader, you maintain your size sane and respect levels and volatility. The long-term arc is more important to long-term accumulators than the daily drama. If you're successful, tell others about it in the comments section to keep them inspired. When the chart is attempting to intimidate people, they need that reminder. I have one more question for you now, because I want community beneficial engagement. What, in your opinion, was more important today? Thin liquidity and leverage unwind in metals due to the headline-driven dollar bounce or the holiday. Which one, in your opinion, was the larger driver, and why? Okay, let's review in simple terms. Gold and silver fell. The dollar twitched. Holiday scheduling significantly decreased China's market participation. Thin markets can quickly produce ugly moves, and liquidity appeared to be lacking. As is often the case when a parabolic run cools off, the mood changed from one of confidence to one of fear. As a reminder that the complex isn't just one-way panic, miners were struck and then displayed signs of life after the lows. The idea that persistence in commodities can eventually lead to unexpected earnings is reinforced by a significant mining story in the background. What does that leave us with then? As a result, the market is acting like it does during erratic bull markets. Additionally, be sure to subscribe if you would like me to continue explaining these moves as they occur. To ensure you don't miss the next update, simply click. I'll see you in the next one, and thanks for watching. For the avoidance of doubt, this content is educational and is based on my understanding of market behavior and publicly accessible data. Your financial advisor is not me. Nothing here is a suggestion to buy or sell anything, and I have no idea what your circumstances are. Make your own decisions, control your risk, and conduct your own research. You can coexist with